Hello everyone and welcome to another episode of Control Cash, your no-nonsense guide to personal finance. Today we are going to be looking into some of the most popular covered call funds out there. If you are a dividend junkie like me and want to live off your dividends in the future, these funds could be the perfect addition to your portfolio, with dividend yields often reaching double digits. First, let's talk about what a covered call fund is and how it generates income. Now, this part's a little complex, so grab some popcorn and hang tight. A covered call is a type of options strategy. More specifically, an options contract is a financial agreement that gives someone the right, but not the obligation, to buy or sell a stock at a certain price before a set date, called the expiration date. From the fund's perspective, here's how this works. They sell call options on stocks they already own, which is always in blocks of 100 shares. That's why it's called covered. The fund already holds the shares as collateral to back up the option. In return for selling the call option, the fund receives an upfront premium, essentially a payment from the option buyer, which is how the fund generates consistent income. Let's break this down with an example. Suppose Apple stock is trading at $200 per share. The fund owns 100 shares and sells a 1-month call option with a strike price of $210. They receive a premium for this, let's say $3 per share or $300 total. Two things can happen by the end of the month. One, if Apple stays below $210, the option expires worthless. The fund keeps the $300 premium, and they keep their shares. Two, if Apple rises above $210, say to $250 per share, the option gets exercised. The fund still keeps the $300 premium, but now they're required to sell their shares at $210, even though the market price is higher. So yes, they miss out on some of that upside, but in exchange, they collect income up front, regardless of which direction the market moves. This trade-off is why covered call funds often show limited share price growth, but offer higher dividend yields. Most of their performance comes from these option premiums, which are distributed as income. Honestly, explaining covered calls would be a whole video on its own, but I hope you get the gist of it. As Warren Buffett says, never invest in something you don't understand. If you would like to see a video on covered calls in more detail, let me know in the comment section. Moving on, now that we know what covered call funds are and how they generate income, now we can talk about some funds that utilize these covered calls to generate income and pay you dividends. First up on the list is SPYI, which is the NEO's S&P 500 High Income ETF. This one is a newer but fast-growing covered call ETF that focuses on the S&P 500, combining broad market exposure with a high income strategy. What makes SPYI stand out is its tax-efficient structure. Instead of writing call options directly, it uses index options on the S&P 500 that are treated under IRS Section 1256. What this means is that the gains are taxed at 60% long-term and 40% short-term, regardless of how long you hold the ETF. On top of that, it often distributes part of the income as return of capital, which can help reduce your current tax bill. SPYI typically targets an annualized yield around 12%, making it one of the highest yielding S&P-based funds available. It's a strong candidate for investors looking for passive income with potential tax advantages, but like all covered call funds, its growth is capped during bull markets. Next up on the list is QYLD, which is the Global X Nasdaq 100 Covered Call ETF. QYLD is one of the most popular and high-yielding covered call ETFs on the market, with a strategy that focuses on the Nasdaq 100 index. It uses a straightforward buy-right approach, meaning it holds the entire index and sells at-the-money call options every month. This allows it to capture significant option premium income, which translates to a very high yield, often between 12% and 14% annually. However, that income comes with a trade-off. Because QYLD sells options at the current market price, it captures almost no upside when tech stocks rally. In fact, QYLD's total return over time has been fairly flat, as most of the earnings are paid out rather than reinvested. Investors looking at QYLD should treat it as a yield-focused income tool, not a long-term growth engine. Last on our list is JEPI, which is the JP Morgan Equity Premium Income ETF. JEPI is currently the largest and most well-known covered call ETF in the market, with over $40 billion in assets. Unlike QYLD, JEPI doesn't follow an index. Instead, it actively picks low-volatility, high-quality U.S. stocks, while generating income by selling equity-linked notes, which are also called ELNs, that replicate call options. This strategy allows JEPI to offer a strong yield, around 7 to 10% annually, while still leaving some room for modest capital appreciation. It's considered one of the more balanced covered call funds, offering solid income without sacrificing all growth potential. JEPI is especially popular with retirees and income-focused investors who want monthly income without taking on the volatility of a pure tech fund. Its active management approach also gives it some downside protection during choppy markets. Remember, each covered call fund comes with its advantages and disadvantages. Some offer higher yield with no share price growth. Some offer tax advantages while others don't. And some focus on indexes while others focus on particular stocks. Keep in mind, despite only being around for a few years, covered call funds have gotten particularly popular with income-driven investors, and more of these funds are popping up each and every year. As always, it is important to do your research and understand the fund's strategy before deciding to add it to your own portfolio. But that's all she wrote, folks. Thank you so much for tuning into this week's episode of Control Cash. Make sure to like the video, it helps out a ton. Let me know if any of the 3 stocks I talked about in this video end up or are already in your portfolio. Again, this is Control Cash, helping you save more, invest smarter, and retire earlier. Keep saving, keep stacking dividends, and I will see you for the next one.